Hey guys, David Robinson here. Welcome to the apartment investing journey. I've got a special episode for you this week. This is a gentleman that is well known in the multifamily investing world. He has many opportunities to share his insight and knowledge as he is asked to speak at different events and training organizations. He has his own training organization and is the founder and CEO of Grow Capitus, a data-driven commercial real estate investment company. And Grow Capitus's 28-person team acquires and builds multifamily and commercial properties across the U.S. They have more than 440 active investors and a portfolio that spans across 10 states with 22 projects and 3,300 units. The result, completed equity raises of 146 million for multifamily, mixed use, and industrial acquisitions in the last 18 months. Over 3,000 units purchased, and Grow Capitus is on track to close another 1,500 units in the next 12 months. So the man that doesn't need any introduction, but someone that I'm excited to have on the show, Neal Bawa. Thanks for coming on. I appreciate you taking some time.
Thanks for having me on the show, David. Very excited to be here.
So we were talking before we started the recording a little bit about some connections that we both have to the Utah market. Before we get into all that, I personally have never heard your journey, your story. Mm-hmm. I've listened to a lot of your trainings, participated in them, even purchased some. And so you are a wealth of knowledge with a tremendous amount of experience. But I want to hear a little bit about your journey and how you even got into the real estate world. So if you don't mind, back up and take a minute to tell us about that.
Yeah, sure. So, I'm a geek, a nerd, a dork, whatever you want to call it, deeply steeped in Silicon Valley culture, the startup methodology, very data driven, very nerdy in the way that I look at the world. When I was 9, I was diagnosed with borderline autism, and I could see patterns in everything, especially numbers. And so they took me to the Army, to the Air Force hospital. My father was in the Air Force. And, over a year, they fixed me so that the autism went away, but the ability to see patterns in everything never went away. So if you remember Matrix, Neo looks at this waterfall of numbers, and he's actually able to see pictures, images, moving things. I'm somewhat similar in that I can see patterns in everything. When I'm walking, in the morning, I see patterns in trees and in grass and in park benches. These are all things that, to me, have mathematical meaning. And so my career has always been like that. So, like, as you can imagine, I'm a technologist, computer science degree, software programming background. So I went into Silicon Valley straight from India in 1997, got hired as a technology instructor. Then they bumped me up to management, ended up running that business successfully until a blockbuster exit in 2013. But while I was doing that, I was making a ton of money and I was paying taxes. I live in California. So, these days, a better name for California is Taxifornia. So living in Taxifornia means that you really have to learn about things like magical things like depreciation and opportunity zones and stuff like that. So, I, for my own benefits, learned a lot about real estate and ended up buying a ton of real estate. I still own. I don't invest in California. My favorite state to invest in is your state, Utah. So I have 5 projects there, and now an extension of Utah. I always think of Southeast Idaho because of the Mormon connection as really a part of Utah, right? Maybe not Boise, but Southeast Idaho feels more like Utah to me than anywhere else. So I'm now extending and doing 2 projects there as well. In California, I don't invest in, but back when I was still a technologist, you didn't dare to kind of go out and invest in Florida or in Georgia, things that I do now. And so I ended up with a fairly large single family rental portfolio in California. And it was interesting. I was learning all these things about data and metrics and how no one uses data in real estate. People talk about it. They give it lip service. Some are better than others. Some are certainly benefiting from the use of analytics. But the level at which I was operating was kind of several levels higher. So I was able to see some interesting patterns and trends that others weren't able to see. And I became passionate about sharing this with other people. And I was lucky because I was running a technology training business that had large classrooms. So I went to my partner and boss, he was the CEO of the company, and I said, I'd really like to start sharing some of my nerdy geek geek-driven insights into real estate investing with people. And given that I'm in Silicon Valley, I think that there might be a few people that are interested. So he's like, sure, just make sure that if you have a presentation, you invite me first. So, he was into real estate as well, and we were all building our portfolios. And so I ended up doing this meetup group, and we started in 2011, I think, inside of my business. And the first meeting, I sent out an email on meetup.com, and 5 people showed up, and I was pretty happy with that. And the next meeting, 10 showed up. And then a year later, 100 people were showing up and basically keenly dissecting the methodologies. So one of them came to me and said, why don't you put this together into like a package or a toolkit and sell it? And I'm like, no, I'm not interested in selling this. He's like, you're crazy. You can make $1 billion in Silicon Valley. It's like, that's not my path. I really like what I'm doing, and I like buying my own real estate. So he's like, maybe you should give it away for free. And I really like that idea. So I was like, okay, but to give something away for free, it has to be more robust and interesting. So I hired a programmer, a data scientist sort of person. I hired a scraping person. I hired somebody that was a statistical major, like on Upwork, basically on a part-time basis. And we put together a package called Location Magic, which basically allows you in 10 minutes to take any random city in the United States, you've never even heard of it, and compare it with any other random city and immediately tell which ones are better for real estate investment, right? Immediately figure out which ones are crappy, which ones are awesome. And it was I became obsessed with the idea of people have to be able to do this in 10 minutes or less, and it has to be free. And it has to be upgradable, meaning when I give it to you, you should be able to use it next year and the year after that by yourself without ever coming back to me. And so it took years to build. And while we were building it, the meetup kind of sort of took a life of its own. And before I knew it, people were calling me to conferences, and I was presenting, and people would be like, so when can I invest with you? And I'm like, I'm a technologist. They're like, so you're not selling anything in real estate? It's like, no, I work in tech. I'm just a real estate investor. And people keep calling me to these events because they think I have something interesting to say. And they're like, but you should open a real estate company. I'm like, yeah, I hear that every day, but my company is about to exit, right? So people understand what that means. And so finally, when we exited in 2013, I was like, well, do I want to retire? I have money. And I was like, no, I'm too young to retire. So it's like, okay, well, let's apply analytics and start this company that is really a real estate analytics company. And so initially we started by basically just looking at analytics and buying stuff. And then we realized we should also build stuff. We should also like buy large multifamilies and raise money from investors. So what was interesting is you'd think that somebody as geeky and dorky as me would have trouble raising money, but I'm in Silicon Valley. So I had near cult status. So ended up with, I think right now we have 550 active investors, and lots of them invest in like 5-6 projects. So, $15 million raises take a couple of days to do because they're really interested in the data and the analytics rather than the property. They're really looking at the methodology that we're using. And so it's gone through a series of evolutions, 22 projects that are in 10 states. Some are gigantic, like $100 million projects. Some are fairly small. There are $15 million projects. And people are like, why would you do a $100 million project followed by a $15 million project? And the answer is the math worked, right? So I'm just obsessed with making math work. And if the math truly works for a property, the size of it is irrelevant, right? So I've literally followed a $100 million project with a $14 million project because they were both mathematically superior to everything else I was getting in the US. And so that's it. I mean, we have 2 exits this quarter. I think one of them will make investors about 40% annualized. One will make them about 35% annualized. So they're really excited and interested. And they're like, can I move this money into another value add? No. They're like, why not? We want to keep doing this with you. And I'm like, well, I don't think value add works at this point. I'm just going to build my own buildings for me, and there might be some room there for you to get in, right? So we're kind of almost phasing out of syndication at the point in life where we are because it doesn't make sense for us, and we're doing some things that you wouldn't hear about. Like, I'm sure you've had plenty of syndicators on your podcast, and all of these people are like, syndication's the greatest thing since sliced bread. And the data doesn't support that. We think syndications are great, but we actually think it's an incomplete solution that is good in certain scenarios, not good in every scenario, and actually should be supplemented by other solutions that people don't tend to talk about because it's not to their financial benefit. So recently I've been talking about this on podcasts, and I get beaten up every once in a while saying, the hand that fed you was syndication, and you're like saying syndication is not the best thing in the universe. Like, I would say it's the best thing in the universe if the data said that.
Right. Well, first off, thank you for taking a moment to give me your backstory and give our listeners your backstory. I'm sure many have heard it, but I actually really didn't. I've heard snippets, so it's good to hear that background and sort of your progression in the space. And I do want to maybe abandon our normal format. And I want to talk about your thoughts on the market today. You share your thoughts on a lot of different forums. Before we started recording, you talked about some thoughts that you have on small multifamily versus large commercial multifamily syndication. I come from a background of helping your average investor acquire small multifamily property for their own personal portfolio, and have added larger commercial multifamily to my offerings to help support my investors' goals. But ultimately, I'm interested in hearing your perspective and why you've made a little bit of a shift in your business model into what I would call small multifamily. So I'll just let you go from there.
Sure. So, I'm going to start because it makes sense to start there with the state of the market as I see it. And David, I am quite conflicted. So what I can't offer is clarity. What I can offer are the viewpoints. And then in the end, you have to basically pick based on what your personal philosophy and belief is. So I'm going to give you the it's very expensive viewpoint and the it's not at all expensive viewpoint. So I'll start with the it's not at all expensive viewpoint. So we plugged between $1 and $2 trillion into the economy in 2008. After that last crash, maybe $1.5 trillion. We've already plugged in close to $5 trillion in various methodologies, 2.5 trillion direct injection, and the remaining is through, asset purchases, stock purchases, all kinds of stuff that the Fed is doing in the background that it has a mandate to do. So us injecting $1.5 trillion into 2008 led to 10 years of the greatest real estate market in US history. So there is some evidence that if we inject double that amount into the market, when there wasn't even a recession, we basically had a 1/4 recession, and the US came out of that pretty quickly by July last year. And we kept injecting the money just to help people in that short term when everything's not opened up. But today, Americans have $1.43 trillion in their bank accounts that they didn't have before the crash. And it's unprecedented because unlike the 2008 crash where the rich got rich, this money is actually fairly well distributed in the population. And poor people, middle class people tend to spend the money they have. The rich tend to keep it and invest it later. So money supply in the US has sharply increased. And the velocity of money has also increased because people are not just keeping their money in the bank, they're spending it. They're spending it on buying homes and on renovations and all sorts of activities. So as a result, you've seen a ridiculous spike in inflation, right? So that spike in inflation comes because if you all of a sudden had $1.43 trillion in your bank, you'd spend some of it, and you spend it much faster than you normally spend. And that's what we're seeing in the economy. And so we're seeing this inflation. And so bottom line is there is a case to be made that the real estate market, or I should say all asset markets in the US, reset. 5 trillion is so big that it's a reset. And it could give us 3 to 4 staggeringly profitable years in the industry to come. And I think that there's 10 or other data points I could give you. The US real estate market is considered by people who live in the US to be very pricey. Those people clearly have not traveled to Singapore, Australia, Canada, the UK, or any number of other countries, because if you go to those countries, everything is 1 cap or 2 cap. Right. So what has happened is with the US had a very large amount of land that many of these other countries didn't have. You think of Australia as having a lot of land, but actually it doesn't because it's mostly desert. You can't live there. Canada, most of the land is too cold, so you can't live there. So these areas ran out of land quicker than we did. But it is now clear that the United States is running out of buildable land because no one in the US, no major city has built a freeway system in the last 30 years. So we're reusing our existing freeway systems. And when you do that, all the low-hanging fruit eventually is gone, and all you're left with is infill projects. And that's really what we're doing. We're doing infill projects and filling it in further. But eventually, at some point, the density becomes too high and the price goes up. So we are seeing spectacular increases in the price of land. Land prices are up 50% since last year. And I was lucky. I bought a bunch of land. And now that people are trying to take that land, back from me at, crazy prices. So bottom line is that when it comes to the US, there is certainly evidence, data-driven evidence to support that easily buildable land, we're running out of it. And we have not made any infrastructure investment in the last 30 or 40 years to build new freeways. And people are like, yeah, but I see that freeway off-ramp being constructed. It's inside of the freeway belt. Like when Dallas built a circular freeway around, that was 40 years ago. Did they build another circle beyond that? No. No one built another circle of freeways. So our freeway system looks almost identical to the way it was in the 70s. But the population of the United States is up 40 million people, right? Mm. So they're still all living within the same area. So you're running out of land. So bottom line is, Fed puts in 5 trillion. We're running out of land. That could be remarkably bullish for all forms of real estate. There's also an understanding that the people who run the world, not the billion-dollar funds, my fund's 500 million, the people that have trillion-dollar funds or $100 billion funds didn't like real estate in the year 2000 because it was less than 5% of their portfolios. Today, it's 20%, and those managers, when interviewed, are talking about real estate being 40% of their portfolio by the year 2030. So there's this mind shift where investors feel that alternative assets are more valuable today. And they're not just talking about real estate. They want to own Bitcoin. They want to own, any form of alternative asset. They want to buy timber. They want to buy all sorts of assets because there's less trust in the government because of the constant, degrading of the currency. So that reduction in trust in non-tangible assets like, stocks or paper money has led to non-real objects, right? One could argue Bitcoin's not real, but it's Bitcoin. You can't make more of it, right? The only way to make more of it is you can mine it, and we know that there's only a certain limit beyond which Bitcoin cannot be increased. So in that way, Bitcoin is tangible, gold is tangible. So we're seeing all of these assets, especially commodities, go completely insane because people are understanding that paper currency is being deliberately inflated. So there's a strong case, I think, for the next 5 years for all hard assets to do well. On the other hand, if you're not bullish, I see problems. I see very significant problems. Today, I am selling a lot of my properties. And so I'll tell you what I'm selling them for. This, I won't tell you the specific property, legal issues. But imagine that I had properties that were 70s build. They had old style chillers. They've got severe problems with septic tanks. They've got problems with sewage. And, 4 or 5 years ago, I would be selling these properties at 6 or 6.5 cap. Now those same old properties are 5 years older, so they're crappier. And now I'm selling them at 4 cap. Now, for those that don't know 4 cap, simply what this means is I'm selling them for about 55% more than they were being sold just 3 or 4 years ago, maybe 3, maybe 4. And in those 55, in those years, the rents haven't increased anywhere near that much, right? So essentially, these properties are just they're just valued more, not necessarily from a cash flow perspective, and people are willing to pay up for that and even get to the point where there's no cash flow for a number of years. That in itself is very problematic. And what we are seeing is syndicators, including myself, mea culpa. What we're doing is we're buying properties, holding them for 24 months and watching that value increase. And because the rehabs have been done, these are properties that somebody already rehabbed once, then somebody else rehabbed them, then we're buying them and rehabbing the last bit. So we're doing a little bit of rehab, but mostly it's the value increase that's coming from the cap rate. That is a dangerous model because if the value increase doesn't come in, you lose money because you paid yourself fees, you paid for buying it, you paid for selling it, you had expenses, you had all those expenses. And so we're making a bet that the party continues. We didn't make that bet 3 years ago because we were getting value increases from the rehab. Happens, rents go up. Now there's a lot less of that. In some of my recent properties, investors have done well or are about to do well because they're not closed yet. And when I look at the gains, a big portion of those gains are coming from the increase in the market. So the all ships rising effect. We did our part, and in some cases we did better than we thought we would on our part. But I still have to admit the truth that the majority of the profit is coming from the all ships rising effect. That is not a robust model because you're making an assumption that is outside of your control. It's outside of my control. It's outside of David's control. And so there's a challenge there. Fundamentally, this market is more dangerous, more risky than the market 2 or 3 years ago. It still has potential for room to go up. There's a lot of things pushing it upwards. But the truth is, every time it gets pushed up, the cash flow decreases, the risk increases, your risk of being upside down goes up. So that's the challenge that I see, that people today are buying 50-year-old properties at the price that they were paying for brand new properties 4 years ago. Mm-hmm. Brand new properties, which also leads me to my next conclusion. And that is, 5 years ago, if you wanted to buy a new property, you would pay brand new property, you'd pay $200,000 a unit per apartment. And you were buying an older property at $80,000 a unit, right? Or maybe $90,000 a unit. So comparable properties, or maybe even $100,000. But there was a big gap. There was, older property, nice Class B property, $100,000 a unit, newer property, $200,000 a unit. So there was a gap there, and it should have been there because you were taking the risk of buying something that was old. Mm-hmm. Today, that $200,000, that $100,000 property has now easily gone up to 160, 170. These are Class B. I'm sure I can give you similar examples for Class C. This has gone up 70,000, but on the construction side, those have only gone up about 30 or 40,000. So the gap between value add and new construction has shrunk. Both have gone up, but one going up slower, one going up faster. So now the risk that you're taking of buying an used asset that could have significant problems, your risk premium is much lower. So I have made a pivot, and now I see some of my brethren in the syndication community making that change this year. But I did it about 3.5, 4 years ago because the math made lots of sense to me. So we shifted to new construction properties, and now we're at the point where some of our new construction properties are beginning to sell, or we're preparing them for sale, and we're seeing astonishing profits there. And I don't like new construction. I like value add. I want to buy buildings and improve them. It's a lot less risky. It's a lot more profitable. But today, new construction has become less riskier in many ways. And people might point me to the lumber debacle that we had. And the answer is, well, it was only really there for 3 months. The price of lumber went to $1,600. Now it's back down to $600. These kinds of things happen. And new construction will fluctuate more than value add. My point, though, is if those fluctuations give you higher profit, and if your value add is not really a value at all to begin with, shouldn't you be looking at that side? So I looked at that over the last 3 years. I did syndications where I built properties from scratch and sold them or kept them for profit. Then as I started looking at it further, I realized there was still a problem. And that was kind of the biggest aha moment I've had. Because what happens is, initially when you start, your investors are not as rich. They're giving you 50 grand for one project. Then as you get more and more investors, you get wealthier investors because people are recommending them to their rich relatives. So now you're getting investors that want to give you 100 grand 5 times a year. And those investors are having conversations with you that are very savvy about taxation and depreciation recapture. And you go think, I thought that syndication was the greatest thing since sliced bread. But as I'm having these conversations with investors that actually might know more than I do, I'm learning that it's not, because the biggest flaw in syndications is we tell everybody and their mother, you're going to get this huge depreciation benefit. And I haven't seen one syndicator one time mention that when I sell the property, and I'm projecting 5 years, but the average property is being sold after 2.5 years today, all that depreciation is going to get recaptured. So you're going to take a massive taxation hit in the year that I sell the property. No one says that, but it's true. You take that hit. So I was like, so for a smaller investor, that isn't such a big deal because their taxation hit on depreciation recapture hit on a 50 grand investment, not a big deal. The property did make money, so they should be happy. But if you're a large investor, and maybe you're in California, New York, blue states where taxes are high, you're really looking for a post-tax solution. So I became obsessed with finding a post-tax solution that didn't involve depreciation recapture. And I ran into lots of issues because I was like, well, I'm just going to build a large number of fourplexes and sell them to investors, and everyone can have their own fourplex and never have depreciation recapture because they're keeping them for 30 years. They refinance them every 5 years. They take money out. And it was like, this sounds really good, but it has a huge problem. And I was like, people love it. They were buying it, but they were pointing out that now I had a new problem. And that was, they loved the professional management and asset management that I was bringing to the whole scenario, so they could just sit back and enjoy our beautiful monthly updates with the videos and pictures. And if you did the fourplexes, that would work, right? So after a year and a half of doing that, we created a new model, which we believe no one in the US has ever done, and we're doing it now. And this model is, we build stuff from scratch with fourplex. And by the way, fourplexes are more awesome than fiveplexes because a fourplex has a single family loan, cheap loan, 30-year locks, easy to get. Walk into Wells Fargo and they'll finance a fourplex, and you have to have no experience. With a fiveplex, you're a multifamily professional, so they look at your resume and they ask you, sometimes to do recourse loans if you're brand new. So there's a big difference between a 4 and a 5. It's a massive difference. So I was like, what if I could build a 150 unit community with an on-site property manager, with an on-site maintenance, and all the benefits of scaled syndication that we've been talking about, right? That we love. But then we run it for 2 years. So you get past the initial bumps on the way, the cash flow goes up and down, that sort of stuff happens. So now you run it as a syndication for 2 years. At the end of the syndicate, 2 years, you dissolve it and give it to investors. Now they all have their own fourplexes. Now they have unlimited depreciation, not unlimited, but it's not recaptured. They have 27 years of depreciation. They can depreciate it all in 1 year or over 27 years. So that's our most recent model. And we feel it's incredibly powerful because the first 2 years is where all the work is. You need an asset manager. You need somebody beating the property manager every week. There's fixes that happen. There's problems with the property. You know this. I mean, you bought, you've looked at these syndications. Most of our work is in the first 18 months. But at the end of the 18 months, we're like, okay, well, that was tough, but we're pretty much done at this point in time. Units are rehab, blah, blah, blah. With new construction, you have different issues. You have, HOA issues to resolve. You've got, properties that have challenges. Maybe the builder didn't build something right and the air conditioners were all bad, and you have to basically go back and chase them and get all of them replaced. So different challenges, but it's the same thing, where there's a choppy year and a half. And also with new construction, your cash flow is going to be lower, right? Because, with value add, you're paying less typically. With new construction, you're paying more. And it's harder to get a loan on those. But what if the syndication had a loan for the first 2 years of running it? And then you had 2 years of appreciation, rent growth. And then you could go to your bank and say, I own this fourplex that's been running here for 2 years. Look how awesome my tenants are. Nobody moves out. Give me a loan. Now you could actually get a much larger loan, right? So you get all the benefits and none of the downsides with a syndication to fourplex model. So I feel like I've achieved financial, I would call post-tax nirvana after 10 years of experimenting with models and understanding that none of them works by itself. Fourplexes have a big problem. If you just buy a fourplex, you're a landlord. And I want my investors to be investors, right? I don't want them to be landlords. So when I build a fourplex community of 150, 150 units, 30, 40 fourplexes, there's an on-site property manager. There's an on-site maintenance staff. Then you're back to being an investor. You're not a landlord. And for the first 2 years, it's being asset managed anyway with monthly updates. And then beyond that point, it's highly stabilized. But still, there's an on-site property manager. Your property manager doesn't work for anybody else. He or she is at the property. So as an owner, you can just call the phone and they will always pick up, and they will know you're the owner of the property. And so you can have direct communication with them. Isn't that awesome? Right? But they're still managing this 150 unit community with all these benefits and pools and, so you get all of those benefits, and then you get ownership with no profit splits.
Well, that is a very great synopsis of the path that you're headed down, and a lot of good reasons why. I want to dissect this slightly. I want to understand and help our listeners to understand, because many of my a lot of my listener base is located here in Utah, right? And so many of them are familiar with the fourplex concept, of a master plan community of a fourplex community, right? But what you're doing is different. Help us
Very
to
different.
understand the mechanics behind what you're doing versus the master plan fourplex community that they're coming in and acquiring from day one, ground up construction.
Yeah. So 3 or 4 major differences. The first major difference is that the way that Utah does it, and it's the one popular company, but there's many others. They ask you to sign on a land loan. So right away, you're on a recourse loan, which means it can go back to your home. We don't. So there's no lending that you're involved in. You're obviously putting money down as an investor, right? That's the first immediate difference, that you're not on a loan of any kind while it's being built, when the risk is highest, right? So it's our risk. We are the ones signing on recourse loans. You're not signing on anything. The second is that the moment in Utah, when you buy a fourplex, there's no fill guarantee. I mean, they're going to basically try their best to fill it, and to be honest, they've done really well. But if things change, then you still get your fourplex, and it doesn't have any tenants in it, and you're still responsible for it. In our case, a professional syndication is leasing it up, right? So that we have full-time asset managers whose job it is to lease it up. They're compensated on that. They've got bonuses related to lease up. So they're looking at it just like any other syndication, except it's your property that they're being bonused on. You see what I mean? So you're kind of leasing it all up. And then many of these fourplex projects that you've seen in Utah are not large enough to have pools and gyms and amenities and have an on-site property manager and on-site maintenance. Many of them are still being managed remotely, right? So they're being managed like single-family properties, so the scale isn't there, right? The other difference, which is huge, is so even with let's assume that they had all of those benefits. Well, the moment you took up your fourplex, no one is actively managing it. With our new model, we are managing it for 2 years, but you're still getting the cash flow. You see what I mean? And you still don't have a loan for those 2 years. You still haven't done any lending, even though you had a fixed price, just like, a fourplex. So the price is fixed. You can't really change it. But all the while that we're doing, professional management, the assets value is increasing, the rents are increasing. And so when you finally get it 2 years later, you're buying it at this price, but because there's 2 years of that property's history, you're getting lending based on its new value and you're cashing out. I don't know how that's possible in the model that I've seen in Utah, because it's impossible to get a loan on anything more than the purchase amount. So if you're purchasing it for $1 million, you're going to get a loan that's 70% of $1 million. But here, there's 2 full years of growth that's demonstrable. So I think the lending becomes much more powerful, and the cash out becomes more immediate.
Well, I've got to be respectful of your time here. Otherwise, I think we could go on for quite a bit longer here. I do want you to clarify or offer some guidance as to the mechanics of, let's say an investor comes and invests in your syndication. You develop this new community. 2 years later, we have a delta between the value and the original purchase price. What are the mechanics around that investor then going and getting takeout financing on that individual fourplex? What do they need to be aware of when they're doing that?
They've got a fixed price, and we've got lenders. In fact, you and I use the same lender. He's a famous lender in Utah. The truth is, there's not much to the mechanics that's different from buying a new construction fourplex the way people do it in Utah. The only thing that's really changed, so you're going to the same lender, you're getting the same LTVs or, LTVs, yeah, they're already built. But the valuation that the lender will look at, they will be much more likely to look at a higher value simply because it's worth more, right? You're just getting a true discount. And you got that discount by, and you still enjoyed the cash flow during those 2 years, right, but you allowed it to build up without any lending being involved. we all know that lending is problematic for fourplexes when in the first and second year. That's when there's more risk. That's when a lot of people have been upside down. So you've already passed through those 2 years. So now the lender feels very confident in giving you the true appraised value of the property, right? But it's still your property. You're 100% owner. You own the land. You own the property. It's 100% yours.
Interesting.
So
okay,
we felt, and by the way, the last thing I wanted to say was that in this model, when you depreciate it, you're also depreciating on its higher value. You're not depreciating it based on its lower value, which you would have done before. So if you do cost segregation, it's based on a larger amount, right? So isn't that more depreciation?
Right. Interesting. Well, you've opened my mind to some possibilities, and so I'm going to have to go and research more and learn more about this concept. And thank you for being willing to share it. We're running out of time here, but I want to start winding down. And so the first question I have for you is, Neal, you have a ton of experience. What's the biggest mistake that you've made on your real estate investing journey so far that our listeners could learn from?
I think it's a straightforward one. My first project in Chicago, I banked on some absolutely spectacular things happening around my project. Like, they were mind blowing. So about 100 yards away, this is in South Chicago, in Jackson Park, the Obama Presidential Library was being built, a $2 billion project with restaurants and apartments and all kinds of things. And I was like, I'm buying these buildings for $50,000 a unit, and they're going to be building $300,000 units. Basically, I could hit a stone and hit the library. And then there was a builder called McCafferty that had purchased the U.S. Steel plant from the city of Chicago. That plant had been shut down a long time ago, and he had about a mile of lake frontage, and he was building 3,000 homes about a mile away. And there were many other projects like this. And so I banked on that future event happening, and it didn't happen. The Friends of Jackson Park sued the Obama Presidential Library and delayed the project for 4 years. McCafferty spent $55 million building a freeway exit, then got into a fight with the city on who should pay for it and abandoned the project. And so the area didn't go up in value. So what I learned from there, the biggest thing I learned is make sure your project doesn't need those external factors to double money in 5 years, because those have to be gravy. They have to be gravy. They can't be the basis of purchase. I see more and more people now purchasing based on future events happening around them. And I've learned not to do that, because that was a very traumatic experience for me. Very traumatic, very stressful.
What's the biggest win you've had on your investing journey so far?
We used our analytics to come up with a market called Dalton, Georgia, which is 35 miles from Chattanooga. It's inside Georgia, but it's a Chattanooga distant suburb. Our metrics were showing that this place was phenomenal. So we go in, we buy a property. Some people said, no, this is really just in the middle of nowhere. You shouldn't be buying stuff like this with investor money. We convinced our investors that our analytics were right. Every single month of ownership, that property has outperformed. Its average occupancy has been 98%, 98 actual percent, and its turnover rate has been 18%. If you know the industry, that means people live for 5.5 years. Average person lives for 5.5 years. Average person lives for about 20 months in an apartment. But the demographics, the analytics were completely right. But that by itself would have given us a very profitable exit. Our investors love it, right? But here's what the real benefit of this property was. We noticed an area at this property that just appeared to be abandoned. After we bought it, we looked at that area and we realized that there was a building there that had burned down. And that building had 20 units. And so we went back to the city and said, so could we build these 20 units? And they're like, sure. And we said, so, you've already charged property taxes accordingly. This happened a couple of years ago. Would you really mess with our property taxes? They said, no, it's internal land already, so you're good there. And so we went back to the city the next time and we said, well, this area actually has more land. Would you allow us to build more units if we could extend the foundations by 8 feet in each direction? And the answer was no. And we kept asking for about 6 months. And eventually they came back and said, you're fine. You can build more units. You can also go up a floor. So we ended up on this abandoned piece of land using an existing foundation, building 29 brand new units, which now give us $30,000 in additional net operating income. By the way, if you don't know how big that is, you're not in the right business. In the apartment business, $30,000, I'll do the math for you, $30,000 a month, and it's all additional NOI because the property doesn't have any more employees, there's no taxes. So $30,000 of brand new monthly income, multiply by 12 is $360,000, and then apply what is known as 5 cap on sale. The property is going to sell for 4 cap, so that's more, but let's apply 5 cap. 5 cap means 20x. That's $7.2 million of profit. That was not projected in the pro forma because we didn't know about this piece of land. And by the way, if you'd like to see what that new building looks like, because this property was called Park Canyon, that project, the 29-unit project, is now called Phoenix at Park Canyon. Get it? Phoenix at Park Canyon. Go to phoenix@parkcanyon.com and check out this beautiful 29-unit building. It's fully leased.
I would call that a win.
Yes. It's very, very excited about the final sale of that. The property is on sale at this point in time. So the numbers are just shockingly large.
That's great. Well, Neal, you've been gracious with your time. What's the best advice you have for any of our listeners who are just starting their apartment investing journey?
Well, it's consistent with what I do. Do more research. Use data to your advantage. You're in the age of enlightenment when it comes to data-driven real estate. People paid $30,000 for loose leaf binders in the 80s, and you can get better data than that for $50 a month as a subscription service. And it's shame on you if you don't use it to make real estate profitable. For the right people that are data-driven and are willing to make those 3 or 4 subscription investments every month, real estate today is amazingly profitable because this is in the 80s, how the stock market hadn't caught up to the high frequency algorithms that have squeezed all the profit out. Well, that's where we are with real estate. And I think in the 10 or 20 years, this profit will all get squeezed out because everybody will know how to use the data.
Love it. Well, Neal, thanks for opening our minds to a new strategy moving forward. For our listeners who want to learn more about the projects that you have going on, potentially invest with you on a future project, what's the best way for them to get in touch with you and your team?
That's the easiest answer I have to give you. I'm the only Neal Bawa on the World Wide Web. So simply type in NEAL space BAWA, hit enter on Google.
Love it. Well, Neal, again, thank you for your time. Thanks for sharing your initial journey with us and opening our minds to a new strategy moving forward. I appreciate it, and I look forward to connecting with you again soon.
Thanks so much, David. Have a good one.